In the preceding chapter, the discussion of railroad bonds was brought to a close. Before passing to the consideration of real estate mortgages, which is the next form of investment to be taken up, it may be well to review briefly the general principles advanced in the first chapter of the book, in order that the listener may have clearly in mind the main points upon which judgment of the value of investments should be based. There are 5 chief points to be considered in the selection of all forms of investment. These are: first, safety of principal and interest; second, rate of income; third, convertibility into cash; fourth, prospect of appreciation in intrinsic value; and fifth, stability of market price. Keeping these 5 general factors in mind, the present chapter will discuss real estate mortgages as a form of investment, both as adapted to the requirements of private funds and of a business surplus. The average American businessman is so familiar with real estate mortgages that the details may be passed over briefly. A real estate mortgage, or a bond and mortgage as it is sometimes called, consists essentially of 2 parts: a bond, or promise to pay a certain sum of money at a future date with interest at a certain rate per annum, and a mortgage or trust deed transferring title and ownership in a piece of real estate, with the provision that the transfer shall be void if the interest is regularly paid and the bond redeemed at maturity. Before advancing money on the security of a mortgage, it is necessary to determine whether the title to the property legally vests in the maker of the mortgage, and during the continuance of the mortgage, it is necessary to have proof that the taxes and assessments are being regularly paid, and, in the case of improved property, the fire insurance as well. The safety of real estate mortgages, in common with the safety of all obligations, depends upon the margin of security in excess of the amount of the loan. In the case of real estate mortgages, the amount of this margin may be determined without great difficulty. It is only necessary to have the property carefully appraised by an expert in real estate values. It does not follow, however, because a mortgage has been shown to possess substantial equity, that it is perfectly safe as an investment unless it satisfies all another condition of great importance. A mortgage may not exceed 50% of the selling value of the real estate pledged, and yet be a poor investment. This point involves a serious objection to real estate mortgages which sometimes escapes notice. The holder of a mortgage is at a great disadvantage in regard to the changing value of real estate. If the value of the property upon which he holds a mortgage increases, the additional value enhances the security of the loan, but does not add to the principal which he has invested. While if the value of the property diminishes, not only is the security proportionately lessened, but if the impairment be great, the holder is frequently compelled to take over the property and may suffer loss of principal. In other words, he receives no direct benefit from an increase in the value of the property, but has to stand the larger part of the risk of a decline in its value. This is not the case with investments represented by negotiable securities subject to changing market quotations. All such securities, railroad bonds, for example, are acted on equally by changes in the value of the property which secures them. Except for the influences of money market conditions, railroad bonds advance with an increase in the value of the property and decline with a decrease in its value. Well-selected bonds usually increase in value with time, and all such increase goes directly to the benefit of the holder. The failure of real estate mortgages to respond similarly to changes in the value of property places the holder of a mortgage at a great disadvantage. Owing to this characteristic, real estate mortgages should be purchased only when general conditions in the real estate market are distinctly favorable. Not only should the purchaser of a mortgage have sufficient margin of security in the particular piece of property upon which he is loaning money, but he should also be satisfied that general real estate values are relatively low, that there has been no undue speculation, and that the conditions favor an advance rather than a decline in real estate prices. No class of property is subject to more rapid changes in value than real estate. After an extensive advance, the holder of a mortgage may be insufficiently protected by the equity in the property, even if his mortgage represents only 60% of the current appraised value of the real estate pledged. It may be that the 60% which he has loaned represents the total value or more than the total value a few years before. When a rapid advance in values occur, though it may be largely justified by the growth and development of the territory, there is sure to be present an element of speculation which is likely to carry prices beyond the point of reason. When the turn comes and a severe collapse takes place, its effects are extremely disastrous because, unlike speculation in stocks or commodities, no short selling exists in real estate to temper the fall, and the immobile form of capital makes liquidation impossible. These considerations serve to show the need for great prudence in the purchase of real estate mortgages. If the investor exercises due care in these particulars, he is reasonably sure of obtaining a very high-grade security. If he neglects these precautions, he may suffer severe loss of principal. No general figures are available which would indicate the degree of certainty attaching to the payment of interest upon real estate mortgages. Certain classes of mortgages, such as those secured by unimproved real estate or dwellings, afford no direct security of interest payment other than the threat of foreclosure. Other classes, such as mortgages upon stores, hotels, or office buildings, are often protected by a large income from the direct operation of the mortgage premises, thus furnishing a security for the annual interest payment. The margin of protection in these cases varies greatly, so that no general conclusion can be drawn. The other characteristics of real estate mortgages may be passed over more briefly. It is generally considered that mortgages return a higher rate of income than can be obtained upon any other form of investment which affords equal security. This constitutes their chief advantage. Their chief advantage, on the other hand, lies in their entire want of convertibility. There is no market for real estate mortgages, and except in special instances, they cannot be readily sold. The fact that they are not subject to quotation prevents them also from holding out any prospect of appreciation in value. Their very deficiency in this respect, however, constitutes an important advantage from another point of view. Since they are not quoted, they cannot shrink in market price in obedience to changes in financial and business conditions. The buyer of a mortgage is assured that he can carry his mortgage at par through periods when it may be necessary to mark down all negotiable securities subject to changing market quotations. This is frequently a matter of great importance. The general characteristics of real estate mortgages may be summarized as follows. First, when carefully selected and purchased under favorable conditions, great safety of principal and interest. Second, a relatively high return. Third, a low degree of convertibility. Fourth, no prospect of appreciation in value. And fifth, the practical certainty of maintaining the integrity of the principal invested. Is a security possessing these characteristics a suitable investment for a business surplus? Only to a limited extent. The safety, high return, and assurance against loss in quoted value of principal are all highly desirable qualities for this purpose. But the lack of convertibility is a fatal defect. No consideration is of greater importance in the investment of a business surplus than a high degree of convertibility, so that if the need should arise, the investment may be instantly liquidated. The fact that real estate mortgages cannot be readily disposed of makes it practically impossible to employ them for the investment of a business surplus. Where convertibility is not an essential requirement, and where the want of promise of appreciation in value is not a serious matter, mortgages afford a very desirable form of investment. The characteristics which they possess in an eminent degree, safety, high return, and assurance against loss in quoted value of principal, are exactly suited to the ordinary requirements of savings banks. Generally speaking, only a small proportion of a savings bank's assets need be kept in liquid form or readily convertible, and accordingly they find mortgages highly desirable. For the purpose of private investment, the attractiveness of mortgages is not so easy to determine. Ordinarily, fluctuations in quoted values are of no great importance to the private investor, so that the absence of quotation which mortgages enjoy is not especially valuable. Their safety and high return are attractive qualities, but their want of convertibility and of prospect of appreciation in value are drawbacks. On the whole, the private investor may probably employ with advantage a certain part, but not too much of his estate in mortgage investments. As part of a scientific and comprehensive scheme of investment, the special advantages of real estate mortgages appear most prominently in the years following a business depression. During such a period, real estate values are usually relatively low, but beginning to advance, so that mortgages present their maximum margin of security. At such a time, they compare most favorably with bonds and other investment securities which are subject to changing quotations, because such securities are then apt to be at their highest point under the combined influence of restored confidence and the low money rates which usually prevail. After several years of continued and increasing business prosperity, the positions are just reversed. No discussion of real estate mortgages would be complete without allusion to the guaranteed mortgages which have been placed upon the market in great quantities within the past few years. Guaranteed mortgages are real estate mortgages guaranteed as to principal and interest by substantial companies having large capital and surplus. In addition to the guarantee, the companies usually search and guarantee the title, see to it that the taxes, assessments, and insurance are paid, and perform the other services of a real estate broker. Their compensation varies somewhat, but probably averages 0.5% That is, for example, they loan at 5% and sell guaranteed mortgages to the investor at 4.5%. The value of the guarantee may be considered from 2 points of view. First, in the event of a general decline in real estate values, and secondly, when a fall occurs in a particular piece of property or in a particular locality. If a severe decline in real estate values takes place, affecting all localities, it might become necessary for the holders of guaranteed mortgages to test the value of their guarantees. In such a case, the question would arise how far the capital and surplus of the guaranteeing companies would extend in liquidating the mortgages which they had guaranteed. This would depend entirely upon the proportion between the capital and surplus of the companies and the total amount of outstanding mortgages guaranteed. Ordinarily, the capital and surplus do not exceed 5% of the mortgages, so that the average guarantee is good for about 5% additional equity. On a piece of property worth $100,000, upon which a guaranteed mortgage of $60,000 exists, the guarantee would be worth $3,000 and would margin the property down to $57,000. This additional equity is of little value. It is probably unlikely that a 40% depreciation in value will take place, but the guarantee is not needed unless it does, and if it should occur, the depreciation is quite as likely to go to 50% or more as to stop at 43%. From the second point of view, the value of the guarantee is much greater. The distribution of risk, as in the case of fire insurance, protects the holder against loss in the event of a fall in the particular piece of property upon which he holds a mortgage, or even in a particular locality. It cannot be said, however, that the records are yet sufficiently complete to form a conclusion as to what is a safe proportion between capital and surplus and outstanding mortgages. Further than that, the guaranteeing companies, generally speaking, have been operating since their inception upon a rising market, so that their success hitherto has not been remarkable. Allowing for these drawbacks, however, the private investor, unless so situated as to give personal attention to the details of his investments, will probably do well to purchase his mortgage